Listen, if you blinked, you missed it. Gold just slammed another all-time closing high, and the dollar is acting like it lost its footing overnight. And before you tell yourself, yeah, it's just another headline, stay with me, because the reason this is happening is not the reason most people are arguing about on TV. And the next 48 hours could flip the story again. Right after this, I'm going to walk you through 3 pressure points squeezing markets at the same time, why one of them is being wildly misunderstood, and the kind of move that tends to happen right after weeks like this. Then, we're going to talk about the one corner of the market that can shock people if gold refuses to cool off. Quick note, we've got 1,000 plus members who get daily members-only videos and early access to every video on this channel, so they stay fully updated with the market. If you want to stay updated like them, consider joining. Just click the link in the description or tap the join button below. It won't take more than 30 seconds. Okay, now comment what time you're watching this, because I always love seeing where the community is tuning in from. Also, check the description after you watch, because I put bonus links down there, including a premium WhatsApp channel link and a channel membership join link. Now, here's what just happened and why it matters. Gold didn't just go up. It didn't just edge higher. It did the thing that makes portfolio managers sit up straight. It pushed through a major psychological zone, then refused to give it back, then closed at a level we've never seen before. That's not a normal rally. That's a message. And here's the first cliffhanger. When gold breaks out like this, the real story usually isn't gold. It's the thing gold is reacting to. Because gold is a mirror. And right now, the mirror isn't flattering. In the last 24 hours, you've heard the usual suspects blamed. Tariff uncertainty, a possible government shutdown, and a big central bank meeting with a press conference looming right after. That's the surface list. But the deeper list is more uncomfortable. Confidence, credibility, and control. Let's start with what everybody is talking about, and then I'll tell you what I think they're missing. Pressure point number 1, trade friction. Tariffs are simple to chant and complicated to live with. They sound like a punch thrown at them, but in practice, they become higher costs that leak into everything. Cars, appliances, parts, food packaging, you name it. And when businesses can't plan their costs, they hoard cash. They delay hiring and they raise prices where they can. That's not ideology, that's mechanics. This week's threats weren't vague either. They were pointed at major trading partners, and markets hate that because it turns supply chains into a guessing game. A guessing game creates 2 reactions at once. Companies pad their margins, and consumers get nervous about prices. Both reactions quietly feed demand for hard assets. From recent market updates, you can see it in the way investors rotate. They don't just buy safe havens, they also dump exposure to anything that needs smooth global supply chains to survive. So the more trade policy turns into a week-to-week surprise, the more oxygen you feed into gold. But here's the twist. Tariffs alone don't usually create a record-breaking gold close. They create headlines. They create volatility. But a record close happens when the market senses something bigger. That policy is being used as a lever, and that lever has side effects no one wants to own publicly. Which takes us to pressure point number 2, the funding cliff. Whenever you hear shutdown, most people picture locked doors and closed parks. That's the surface level movie version. And the deeper issue is credibility. Because a shutdown story is really a story about priorities. It's a story about whether a government can pass a basic funding package without attaching unrelated fights to it, like a grenade pin. And this week's cliff is classic. A big spending package, a midnight deadline on Friday, and a political standoff over how a security agency gets funded. And how it enforces the law. That's not just budgeting. That's a power struggle being conducted with the lights on. Now, here's something most people don't realize. Markets don't panic because the government closes for a few days. Markets get uneasy because a government that argues like this also tends to govern like this. Short-term patches, last-minute deals, temporary fixes. And then we act surprised when the debt clock keeps spinning, which leads to the number that should make everyone pause. The national debt sitting north of $38 trillion. That number matters less as a scary headline and more as a constraint. Because every additional dollar of debt is a future claim on taxes, inflation, or both. And if you're trying to understand why gold is acting like a smoke alarm, you need to ask a simple question. What happens when the smoke alarm goes off and the people in charge argue about whether the alarm is too loud? Now, pressure point number 3, central bank week. This is the one people pretend to understand until the chair starts speaking. We're in the part of the calendar where everyone asks the same question. Rates up, down, or unchanged? But that's not the question professionals are really asking. The real question is, does the central bank sound like it's in control of inflation expectations? Or does it sound like it's negotiating with them? Because here's the quiet truth. Markets can tolerate a lot of pain if they believe the rule book is stable. They can tolerate higher rates, lower rates, slower growth, faster growth. What they can't tolerate is uncertainty about the referee. And that uncertainty is heightened right now because even when some economic data looks decent, like certain manufacturing orders or big ticket purchases, people don't feel it. That mismatch is gasoline. Based on recently published numbers, consumer confidence just dropped to the lowest level in more than a decade. That doesn't mean everyone is broke. It means people are anxious. And anxiety changes spending, voting, and investing. So you've got trade friction, you've got a funding cliff, and you've got a central bank meeting that can change the tone of everything with a few sentences. Now, here's where the conversation usually splits, and this is where retention goes up if you pay attention. One camp says gold is rising because the world is scared. Another camp says gold is rising because the dollar is falling. A third camp says gold is rising because central banks are hoarding it. And a fourth camp shrugs and says it's a bubble. But I think there's a more honest way to frame it, and it's going to sound uncomfortable at first. Gold is rising because the story of we've got this under control is losing believers. That's it. That's the engine. And if you want proof, look at the dollar's behavior. The dollar has been sliding against a basket of major currencies. And it's been especially weak against the currency everyone runs to when they want stability. When you see the dollar at multi-year lows against that safe haven benchmark, it's not just a chart pattern, it's a confidence poll. Now, I want to make this engaging, so I'm going to do something different. I'm going to recreate the debate you've been seeing, and then I'll tell you which parts I agree with, which parts I don't, and what I'm watching next. Picture a host asking, what's driving gold right now? Tariffs, the shutdown threat, rates, the general risk out there, or central banks, and the guest fires back. It's all of it. But the bigger problem isn't that the government might shut down. The bigger problem is that it keeps operating the same way. That line lands because it feels true. Because the real risk to a currency isn't one dramatic event. The real risk is slow, persistent behavior, deficits that don't shrink when times are good, promises that expand faster than production, and a political culture that treats hard choices like optional side quests. But here's where I'm going to push back, and I want you to tell me if you agree. Saying the dollar is going to collapse makes for great TV. It can also make for bad decisions. Currencies don't usually die in one day. They decay, they wobble, they get rescued, they get supported by policy shifts, and then the cycle repeats. And the dollar, for all its flaws, still sits at the center of global trade, global debt markets, and global banking. So I'm not here to sell you an apocalypse movie. I'm here to help you recognize incentives. And the incentive of a heavily indebted system is to reduce the real burden of debt over time. Sometimes that happens through growth, sometimes through spending cuts, and very often through inflation and currency weakness. That doesn't require a collapse. Oh, it only requires a drift. And a drift is enough to make gold look smart. Now, the host usually tries to counter with something like, but hold on, we're getting decent numbers. Incomes are solid, productivity is rising. How can you call this a cold economy? And the guest says, those numbers are skewed, they'll be revised. Inflation is masking weakness. Gold is warning you the way it warned before the last crisis. Okay, here's my take. Yes, revisions happen. Yes, inflation can distort nominal data. And yes, markets often sniff trouble before headlines do. But we have to be careful with the everything is fake reflex. Sometimes the economy really is mixed. Sometimes corporations are fine while households are stretched. Sometimes the top slice of consumers is carrying the whole party while everyone else is counting pennies. So you can have a world where gold is right to rise even if not everything is collapsing. That nuance matters because it changes how you position and how you manage risk. Now let's zoom into the dollar because this is the part that most people feel but don't connect. A weaker dollar is a double-edged blade. If you sell globally and report in dollars, a weaker dollar can make overseas revenue look larger when it's converted back. That can lift stock indexes even when the real purchasing power is eroding. That's why you'll sometimes see the market cheer while the grocery bill still hurts. But if you import what you consume, and a lot of what we consume has foreign inputs, a weaker dollar also means higher costs. And higher costs can keep inflation sticky even when growth slows. So when someone says you don't want too strong a dollar, they're not wrong. But when someone says a weak dollar is good, they're not always right either. The real question is weak relative to what and weak for who? Now, here's the twist that keeps people glued when they finally see it. Gold isn't only reacting to the dollar being down. Gold is reacting to the idea that policymakers might accept a weaker dollar as an outcome, not a problem. And that's why every tariff headline matters. Not because tariffs magically create wealth, but because tariffs can keep prices elevated while growth cools. And that combination is uncomfortable for any currency. According to the latest publicly available filings, many large institutions have been quietly increasing allocations to inflation-hedged assets over the past year. Not because they're panicking, but because they're hedging a regime change. a world where purchasing power is defended less aggressively than before. Now, let's talk about central banks, because this is the part that people sensationalize. Central banks are buying gold. Sounds like a conspiracy headline. In reality, it's often boring and strategic. If you're running a national balance sheet, you want reserves that aren't someone else's liability. You want assets that can't be frozen with a keyboard. You want diversification. And Clear's throat gold has served that role for centuries through empires, through wars, through monetary experiments, through policy mistakes. So yes, central bank buying matters. But no, it doesn't mean the dollar evaporates tomorrow. It means the world is slowly spreading its trust around. And that slow spread can still push gold higher for a long time. Now, here's where people usually ask, so what do I do with this? And that's the wrong first question. The better question is, what story am I actually betting on? Because gold isn't a trade you make because you're scared. It's a position you take because you don't fully trust the long-term path of policy. If you believe policymakers will prioritize stability over purchasing power, gold makes sense. If you believe deficits will keep expanding because no one wants to touch entitlements or taxes, gold makes sense. If you believe inflation will be tolerated rather than crushed, gold makes sense. But if you believe productivity growth will surge, fiscal discipline will return, and real rates will stay meaningfully positive, then gold becomes less attractive. That's the honest fork in the road. This isn't about hype, it's about assumptions. And assumptions are where most portfolios quietly break. Because people think they're diversified, but they're really just betting on one outcome expressed in different ways. Stocks, bonds, real estate, all quietly leaning on the same policy support. Gold sits outside that structure. It doesn't care about earnings calls. It doesn't care about GDP prints. It reacts to confidence. And right now, confidence is fragile. Not gone, not collapsing, but thin. And thin confidence is enough to move prices. So when you see gold at record highs and the dollar slipping, don't reduce it to a meme. It's not just fear. It's not just speculation. It's a signal that the story people believed a few years ago is being quietly rewritten. And rewrites don't happen overnight. They happen line by line, decision by decision, policy by policy. That's why this move matters, not because it guarantees disaster, but because it tells you how incentives are shifting under the surface. And once incentives shift, behavior follows. Spending changes, investment changes, hedging changes, and markets reprice slowly, then suddenly. Gold is just one of the first places that repricing shows up.